Hey, welcome to the first episode of the Mortgage Athletes. This is a roundtable that Tom Reber of Cross Country Mortgage and myself, Tracy Hayes here at LoanDepot have created. And we've brought on one of the legends in the area, very popular, John Adams, to be our first guest this week. And we look to have this talk every Wednesday at noon, talking about mortgage stuff. So if you're a real estate agent or a mortgage lender, just looking to get insight from, between the three of us, I think we have well over 50 years of experience in this business. Just some of the things that we might be doing, tips and tricks, just some insights, some translations of some of the stuff that we see in the news articles, and what our predictions are each week as the climate changes. So, John, I want to welcome you to the show. John just wrote a book. It came out a few months ago, House Hacking: How to Use Renovation Loans to purchase loans, and he has a lot of great stories of the podcast on the Real Estate Excellence podcast. I had him on, but John, you're up in Fernandina, is your hot stomping ground because you've been up there a little bit. Tell us a little about what's going on, what you see going on in Nassau County and Fernandina to kick us off here.
Oh my gosh. Well, I mean, there's so much things that are going on within the real estate economy. I'm licensed in 13 different states, and we're seeing a decline in a lot of different places. But the anomaly, the thing about God's beautiful waiting room that we have here in Florida is that we're not seeing the declines that everybody else is seeing. So while we have a lot of people in the industry, in the business, especially in the mortgage and real estate, their careers are becoming more hustle, and they're learning how to work again. We're learning how to do open houses. We're learning how to value proposition our clients and provide multiple different solutions. So while there is a bubble, housing bubble, if some people want to say that, going around the country, it's not happening here. We're a bubble within a bubble. And more particularly up in Amelia Island, I mean, we're running out of $5 million houses to sell. So if that's a problem, I don't know what is. The economy probably not looking too good this year, but as far as Florida being almost a country within a country, so to speak, right now, everybody wants to be here, and people are evacuating other areas to come to the promised land of Ron DeSantis.
Yeah, yeah, no doubt. Tom, what are you seeing at Cross Country?
Well, I would agree with John. The North Florida market is very, very strong, very solid. We're seeing activity. We're seeing purchase business happen. There's obviously fewer buyers, but there's also enough houses to keep the synergy moving forward. Up into 32034 zip code where John's at is very, very active. It's a great location. So zip code driven. We have probably 10 of the best zip codes in all of Florida to live in and location-wise for both families as well as vacation. When you combine all that together, it keeps the juice flowing in the greater North Florida area for people not only here locally, but the migration is real. It's still happening here where people are coming to North Florida from other places. It's still very strong. So it's great point there, Tracy.
So do you guys, my opinion, personally, even though some people may see what seems to be slow right now is a kind of a quiet before hopefully a good storm as we go, get closer towards, summertime and what people consider traditional buying time, though in Florida it's always warm. So we don't really have like being up north or something where it's snow and they don't sell their houses and move in the wintertime. But anyway, is the demand because Jacksonville has created such a job market here especially of a lot of white collar jobs. We're in the top 10 of cities to move to right now as taxes, job growth, and so forth. And as John's mentioned, the many lifestyle benefits here. So to anyone listening, if you're a loan officer or realtor and maybe like going, hey, I don't see this hot thing going on, just keep doing what you're doing. Keep making the phone calls. Keep putting yourself out there. Keep working the open houses for the agents who don't want to work open houses, because when the dam breaks, you're going to be already moving forward and be able to roll with it. Would you agree?
Tom hit it on the head when he was training me back in our old big bank stagecoach days. You know, the activities and the sales call reluctance. Whenever I was being coached up as a younger man, those are the things that we did in the downturn in '08 really well. We didn't forget about those who were in the trenches with us. And so when you go through these types of curves, it really goes back to doing real work. 2 years ago, you sat in your bunker and people called you and did mortgages. You could let people, sit in your voicemail. Today, if you don't call them, a trigger lead is going to hit your client. If you don't educate your client about the trigger lead, 30 people are going to call in behind you right now if you're selling a loan to somebody. So there's a lot more education. But when you're playing this game, it's a lot more than just a tackle strategy. Wouldn't you agree, Tom?
Totally agree, John. And bringing back to where we were in 2008, 9, and 10, and the fundamentals that we learned back then, weak markets create strong loan officers. Strong markets create weak loan officers. Our challenge today is can we become strong again? And yes, we can. We just have to go back to the fundamentals of blocking and tackling, making qualified relationships, making sure we optimize our time when we do make sales calls. The good news is today, the technology is 10 times better than what it was back in 2009. The information is 2,000 times better because today, as you've heard me say many times, it's people, process, technology in that order. But the technology supports the process and enhances the sales piece. And we have to utilize that technology to the fullest, which we're doing today. But there's nothing that beats hand-to-hand combat sales and pressing the flesh and being present to win. That's the stickiest of all. Because if you say, hey, I'm Tom Reber and I'm real, there's a better than good chance you're going to have a conversation with me of substance. Great points, John. I'm glad you remember those because that's going to bring us through this 2023. One other point I wanted to make globally is traditionally in the state of Florida, January is the frozen tundra of January for us. It's usually slow. And then we get February 15th. And then all of a sudden the thaw happens. We have to be prepared and ready. As the mindsets change, the spring fling happens and we've got to be ready to rock. So what you do today is going to multiply your success in March.
Right. So to reach out to some of our, obviously, hopefully some of our referral partners and realtors are watching as well. And some of the education videos that I'm trying to put out too is to the consumer and preparing themselves credit wise, because we are seeing, at least I believe, and you guys hopefully agree with me, I assume you would agree with me, is a lot of applicants coming in who are renters, and obviously rents are going up, and they're like, man, it's getting too expensive to rent. I need to actually look to buy, and their credit's not so hot and so forth, and they may be looking at a house, and all of a sudden you pull their credit, and you're like, they ain't buying this month. It might be 90, 120 days. What should these real estate agents be recommending to these, a lot of them are first-time home buyers, obviously, to, get with their mortgage lender and start clearing the path here should they have some credit issues? John, what are you telling your guys, your peeps?
Well, first of all, you hit on a couple of really good points. Number one is our past database of clients from the last 2 years. We didn't pay a lot of attention to the folks that maybe didn't have great scores and they were renting. Guess what? During the pandemic, they had some money, they had some opportunities. They probably got themselves to a better place to buy. So you already probably have some gold in your database. A lot of people, again, not doing the activities that they were used to doing in the last few years, and that may have went by the wayside. So they may already have some gold in their pipeline. And that's with upcoming folks too that you're seeing right now. We're seeing a lot of people that are inquiring that may not be in a place to buy today, but that's okay. They're in your pipeline. They are going to be customers, especially if they're renters. And that's the great thing about the market that we're in compared to like an 08. Right now, we know that there's more housing creation that's needed based on family start creation. And I think Barry Habib, covered this really well. But to steal a couple of pages from his playbook, he basically let everybody know that way back in the 70s, there was an event that happened in legalese that allowed people to go through, it's a very controversial subject, not saying one way or the other, but abortion. So abortion created a lot of less family starts. Fast forward to 2008, those 33-year age families, not as many of them. So we overbuilt. Right now, we don't have that problem. As a matter of fact, we know that there are more family creation starts than there are housing. So people that are out on the media saying there's housing creation issues, it's not. There's not a housing bubble here. We have more families than we have houses. It's just simple math. And most of them are being institutionalized. So the real question becomes, the everyday worker, especially up here in Amelia Island, our service industry people, our teachers, our first responders, where do they live? They're getting pushed out further and further. Interest rates have gone up, prices have gone up. I think they're stabilized. So where do we get all the quality people that are going to help support us? Where are our down payment and assistance programs? That's where Head Start for homeownership, Hometown Heroes, and H2H funds. They're coming in handy in Duval County areas. So those are the opportunities. The strategies and weaknesses of the people that are coming to us right now are looking for guidance. And it's really about how we manage our database. And again, back to the last question you had, it's back to basics. You probably over the last 2 years have been overlooking those opportunities that you put in maybe your CRM and said they're in credit repair. Well, did you reach back out to them? Tom?
Yeah. Thank you, John. I appreciate that. Reminding me to go back and reach out to the folks that need it the most, obviously. It was interesting. We had the Jacksonville MBA meeting with a great speaker, but one of the things of themes around the room was affordable housing. We had a couple of community leaders come in and reminded us it starts with housing. Our economy starts with housing. Housing makes our economy turn. And there's 167 proven things that happen when you buy a house. So many things happen with that. We have to get back to the fundamentals and apply the science and grow our customer opportunities and show them the way. Leadership, education. To your point, John, it's a good point. Appreciate you bringing that back up.
Well, the point, and all those points are great. It was I wanted to get out to the real estate agents is get your applicants in early, because there are roads that they may need 30, 60, 90, 120 days to get that credit fixed, and it's why they're renting. And we are able to obviously evaluate that. We have software to give us the answers that they want and a path of getting approved. So I've dug into
Tracy, you're right on that too, man.
Yeah.
Like especially with the XY Gen, they want to do text, they want to do less interaction. They're thinking they got until like the end of March. We're on the cusp of February, but that's when my lease is going to break. But they're not thinking, they're just, using their TikTok mindedness to go online and say, well, I don't want to pull my credit yet. No, now's the time to pull your credit so you can be prepared and have a game plan. So you're absolutely right about that. I think a lot of the newer generation is missing that part.
They think it's going to happen overnight, and it doesn't. Some of us takes time. I've been trying to do some more educational videos talking about credit and so forth and how it pulls, and because there's a lot of fallacies, old wives' tales, I like to call them, out there about it. And the more of the loan officers who are saying the same thing, the more the real estate agents say the same thing the loan officers are telling them about their credit, the better we can guide more of these people to getting that correction. Now we just got to build more houses faster. That's the next step. So I'm going to dig into some of our questions here that we talked about. Actually, I said pre-show that I wanted to talk about. We're seeing a lot of loan officers putting little stuff on social media. One of the top loan officers, hopefully we'll have him on the show eventually, did a little YouTube video talking about Fannie Mae and Freddie Mac and their loan level pricing and so forth. But to me, it was Tom, you're much better at this and describing it. But to me, it was a bunch of hogwash, because it just seemed like they were, we're going to not charge them over here, but we're going to charge them over there type of thing. Can you kind of give us a little insight or skinny on that?
Well, I'm going to give you a taste. Fannie Mae has what they call a G fee, which is what they charge the lenders to sell loans to them. And they've increased that, and it increases margin for them as we sell loans. It just makes it technically passes on the consumer. At the Mortgage Bankers Association, this is being addressed at a high level. But we as lenders, as mortgage bankers, as brokers across the board, the variable piece of this that really is concerning to me, Tracy, is the one that they're going to give a loan level pricing adjustment based on their back ratio. So if the back ratio is 40 and at final underwrite, or let's say clear to close, they recalculate the income and they redo some credit pieces and the back ratio goes to 41, there is a loan level pricing adjustment at that time. That, in my opinion, is going to be extremely difficult to deal with from a lender's perspective, much less a customer's perspective, because that's moving the bar after you've disclosed, after you've put all this information out there. Now all of a sudden you have to, hey, possibly hit the customer for another 50 basis points because their ratio went from 39.6 to 44.
Right.
And that, in my opinion, is going to have to be addressed. Hopefully that'll get that taken care of. In theory, Fannie and Freddie have tried to make it more affordable for the lower credit borrower to not get hit as much for their loan fees behind the scenes on trying to get financing, and have taken it away from the higher end credit score. Bottom line is you can do most of that stuff behind the scenes, and it's, shopping and rates and points and things like that come into play. It's the one variable piece that concerns me the most, Tracy, with regards to that back ratio. That 40 back ratio number is a moving part. We all know great mortgage athletes craft a transaction based on the cash flow analysis. We do a wonderful job of doing total cost benefit. And if they have a 46 back ratio and you're able to make it work, you get an approved eligible DU or LP, yay, you're a winner.
Yep.
The challenge comes in is now we're going to be moving a target and we can't hit that target because of the 40 back ratio and the price adjustment that may happen because you disclose here, the target moves a little bit over here. Now you have to go through a redisclosure process, which is the real challenge. I'm waiting for that to bubble up and really become quite the topic.
Mm-hmm. Which actually, John, would you agree? All of a sudden you're pushing a closing out possibly. There's costs that everyone involved is going to incur at that point. And then you got to make that phone call. If it's not a phone call you want to make in the week before closing, that all of a sudden, hey, we need you to bring in more. We need you to bring in more money.
So, we've had in the last, 18 months or so, we've had some really, kind of chaotic things that I think the general consumer doesn't understand about loan level pricing adjustments. And one of the biggest, I think, blunders that we're not even talking about, but we kind of talked about, but we grazed over it in time. And I'm not talking about us, just in general in the industry, is the pricing hit that we've experienced with regard to second home adjusters. So there was quite a few people during the pandemic now and today legitimately buying a second home, and legitimately, if you use that for most of the year, it's still a second home. You can still rent it out. And now the industry has gone for a pitchfork party association to call everybody that bought a second home fraudulent because they rented out 3 months out of the year or whatever. And now they're trying to stick everybody with loan level pricing adjustments, which is only hurting the ability of folks to go out and buy the homes. This hasn't hurt institutional investors. No legislation has been made to stop, institutional buyers from coming out and buying whole communities and taking those off of the inventory supply forever, or regard to if for some reason all the institutional buyers were to think about tomorrow freaking out and selling all their inventory, it would crash the American real estate infrastructure as we know it for price. So nothing's being done to wrangle that in or regulate that. And I think that's probably the biggest miss. There's always, we're always met with challenges and opportunities in our business. And I agree, like the DTI and the changing variable rate, the Rubik's Cube, you will, of the closing process. It's surely a challenge, and we always have a lot of unintended consequence when we get these, pricing adjusters. But the forest for the trees is a little bit of a ability to give the low to moderate income buyer a break on pricing, even though they kind of made it up in other areas with Fannie Mae, but across the board. So it is a little bit of a win. So I'll take it for what it is. And we always need to lean on our legislative partners to help us with the things they may not understand about our business, but they try to help us out with, and they just do a piss poor job of it. But we've got a lot of challenges. This is one of the most recent with the opportunity for the CRA or the give back to these low to moderate income folks. So I'll take it for what it is, but you're right. There is a process problem, and I think our politicians just don't understand.
Well, you brought up something I never had thought about that before. The institutional, and for anyone listening, what we're talking about is someone literally going in, and the large builder that I was working for lender-wise, last year, they literally had a brand new community, hadn't even broken ground yet. And that institutional buyer came in and probably, bought 20 or 30 townhomes from them right up front in the community. Now, to me, they're along the road. They're less desirable, but they are taking them off the market. Are they being restricted on the rent? Now, it was great for the area because we need more rental units, but the question is, what are they renting them for? So are they having to give a little bit for their ability to buy that many properties versus the homeowner that might want to buy one or two, have a second home, maybe they got an investment home. Either they're really being penalized by the quote second home purchase, where they are paying basically what an investment property would cost. You just pay less money, put less money down because they call it a second home, but they're going to pay the same interest rate as well. I never thought about the institutional buyer. That was a great point.
Great topics, everybody. Really strong.
Yes. Challenges serving underbanked and low-income communities in home lending. I think we're in that subject, and we all, the Florida down payment assistance programs. John went through all the great names of them before, but we running into a situation as we're pushing those people further and further west. But with inflation and everything, their salaries and so forth are not meeting the criteria. Really, it's getting more and more difficult to get those people approved unless they've got, they're buying with a friend. Maybe two individual head of households get together and they're two friends and they buy in and together, and which is not always the greatest situation because if one wants to leave, but not everyone has that friend either that wants to buy a house with them and make that commitment. But it's getting tougher and tougher in our areas. And I know, John, you're primarily up there in Nassau County. I know St. Augustine has that issue as well, is serving those lower income communities and let alone just enough rental properties. The apartments are going up everywhere in the area, but they're not like income protected apartment complexes.
No,
What's my question?
Yeah, well, I mean, you're absolutely right. So, I mean, I'll give you a tale of two cities, and I'll couple it in with your first statement and then end on my second. I had a borrower call me yesterday. He's a veteran. He said, John, you sent me approval for $215,000. That's the most of what I could get for his VA approval. He's like, I can't buy anything for that. So, I mean, what do we tell people when you send them out a pre-approval and it's useless? They don't. So we have renovation for that, but let's be honest, contractors still cost a fortune right now. So renovation will have relevance. It's just gaining relevance. It's just not there today. So there may be an opportunity to find a house that needs some work and he can get in that price range. But there's no brand new construction in that price range. And if it is, it's being gobbled up by the institutional buyer. Different story. We'll talk about Amelia Island for a minute. So we had some low to moderate income housing that was supposed to be, they got some variances for the city that was built in Nassau County right by the Southside Elementary School. Come to turn out, these investors did short-term rentals in there, pulled them off the market. Now there's no rent control. They're $2,000 a month. Meanwhile, we're out in Yulee trying to build a bunch of like 275 unit PUDs, and the entire community is trying to not get them to build that because they say it'll lead to all these bad things. There's no rent control. It's almost the wild, wild west. And it's a contradictory of all statements. We want to help educators, first responders, the people of this community that have been here and live here, and we're pricing them out of the market every day. But then, the places that we have found we want to build, nobody is in favor of building them. So what do you do?
Yeah. Tom, you kind of rub elbows with some of the politicians. I mean, there's a lot of talk, but are we seeing any action?
Next year will be interesting as we get, or I should say this year, as we go into the political season. It all starts with housing. It starts with our local leadership having some direction. This is where we as individual mortgage leaders need to communicate with our city councilmen, our county commissioners, and give them some direction. And I don't know how we're going to be able to do that effectively, but we need to, whether it's the new mayor coming in and in the greater Jacksonville area, but the county commissioners, it is real. We all agree it's real, and finding affordable housing is in front of us, and their solutions are there too. It just has to, the collaboration has to come together, and we have to stick to our plans. To John's point, somebody's got to take it and run with it and not just give us lip service to your point about, hey, we recognize it. It does start with housing. Then what are you going to do about it? And then you can say it's on you, because it's on you. You didn't do anything about it. And we're back to where we were. Nothing's changed in the past 10 years because really nothing really has. I know St. Johns County's done a few great things, and they've put some housing down there. The St. Johns County Coalition for Housing. I haven't been super involved. I watched it from the outside. I know obviously Nassau County's done some of that. Duval County's done some of that, but we've got to close the gap between leadership that's empowered to do something than just an actual, sub little a piece inside the government that says, hey, we're here for housing. That's great. You're allocating money. Make it go away. No, we need actual physical houses. We actually physically need dirt, and of that dirt, apply that methodology to provide affordable housing for the right people.
Right. Tom, can you touch a little bit? Obviously, we had the event last week on Mortgage Bankers Association in our unit here in Jacksonville, and you and I talked. We want to get that up and strong again. That's your dream, and I'm with you on it. To any mortgage loan officer might be in, or maybe I'll cut a reel out of this. Just express the importance of being part of that association and helping and getting some of the things that we just talked about moving forward.
Well, in a nutshell, the Mortgage Bankers Association is the foundation of our careers. It is the voice that we have locally, statewide, as well as nationally about what our needs, our concerns are, and being able to effectively have a voice to what our careers, our abilities can be. All loan officers, all mortgage companies need to be engaged and involved because they do have a voice if you choose to participate. It's check your logos and labels at the door. Be ready to explore. Go meet somebody new. Go shake some hands. We had a great turnout. We had over 85 people at our meeting last week. We need to grow on that. We need to continue to share and be willing to give information. We need to also invite people from the outside, such as the leaders that you were speaking of, Tracy, the county leaders, the community leaders, to have this conversation. Because at the end of the day, you don't know what you don't know. And if it's not in front of you, you won't know about it. But by bringing these groups together, we can have a strong voice, but we can also have direction. And that direction is strength in numbers and having a point of emphasis of what we need to do, like the loan level adjustments, like affordable housing, and be able to funnel that in and say, okay, this is what we need, Mr. Governor DeSantis. This is a solution. Those are things that need to be done.
Would you agree that we should also invite some of the RPAC representatives, or any real estate agent really, but definitely
absolutely. Real estate is very important. Their voice, their leadership, they've done a phenomenal job. We work hand in hand with those folks as well, but we can have a common voice because financing is the spark of the transaction. You have the real estate side, financing helps sell houses. You put them together, you have a win. Everybody comes together. But you don't have a house without typically money. We help bring the money. They help bring the house. We put it together. We have combustion of an opportunity, and we provide shelter, which is one of the three primal needs of our lives: food, water, shelter. And we're the catalyst of that part, and it's important.
I was at I've been on the Affordable Housing Advisory Committee in St. Johns County for, I think, the last 4 years or so. Anyway, the last meeting, I think it was in November. You were mentioning the St. John's housing there, Bill Lazar, and he mentioned about loan products. Is there really any more we can do there's so many loan products out there for so many different things. Is there anything if there was a dream product you could create, but really is that the situation, or we just don't have the affordable housing product even lend on? Can we do more as the lending world and creating a more fancier product? I want both of your opinions on that.
John, you want to go first or me?
I'll let you take that one first, Tom.
All right. So ideally, you have challenges. My opinion would be we would take a chunk of money as a set aside, knowing it's directed for a certain type of borrower: first-time home buyer, community servant. That fits the bill of the affordable housing piece, mirrored after more of a VA/USDA type loan, no money down. You know exactly what you're investing in. You know exactly the borrower you're investing in. And if you understand what you're doing there, that's the chunk of money that's lent out at a fair market rate, at a fair market price, and you invest in your community. And so to your point, Tracy, I think St. Johns County needs to invest into St. Johns County. Duval County needs to invest into Duval County. Relying on the state of Florida to invest in all the counties is great, but community leaders, just like local banking, local loan officers, we live here, we work here, invest here, invest in your community, have a product and program to be able to do that. So if it's just a 30-year fixed with no money down at a fixed rate, but you take a lot of the lending guidelines and smooth them out and say, hey, you don't have to have a 640 credit score. You have to qualify the old-fashioned way like we did back in the 90s. Let me look at your abilities. Let me look at your credit profile. Let me look at your asset position. We will lend money to you based on your abilities and willingness to repay. John, what do you think?
Those are all really great ideas. I've always been a big proponent of private entities should take care of a free marketplace to make, necessity the mother of invention. Right now, builders are building 3,000 square foot, 5,000 square foot monstrosities. You don't see a lot of efficient land use. You don't see incentivization of a builder, maybe either in impact fees or speed of getting approval for projects. Maybe those are incentives that you give builders that are willing to come with the solution. Where's my 3-2 that's 1,000 square foot? Maybe they're shotgun, but you can build a lot of them at a lower price.
Right.
Where's my private incentivization for builders to get on board with that? Because otherwise, if it's same per square foot, I'm going to make $1,000 a square foot for building a house up here in Amelia Island. Where's my incentive? Where am I incentivized to help the community? What can I do to give back? How can you help me build these houses? Right. Yeah. And so when we can start figuring out ways to incentivize builders to start getting land use for people that can have affordable housing, that's when we'll solve the problem. Because right now we can do a lot of talk about it, but until we can actually build this field of dreams, nobody's going to play ball.
Correct.
Oh, that's brilliant. Both, my thought is, back in the days, there's talk of the accessory dwelling unit, right? California's dealing with that. Yet to build communities that are affordable, maybe true duplexes, so they can live in one side, rent the other side out. So now you also have rent, obviously offsetting the cost of the home, but providing an affordable house, but also an passive income solution there to offset their housing costs. That's been something that I think we lack on. You go up north to the old cities like Detroit and Chicago and, all around New York, they all have accessory dwelling units around them. They were all built that way, and duplexes were common. You don't see those anymore. And but I agree with both of you guys 100%. Guys, we're going at about 33 minutes. Does anyone want to throw something out there that's on their mind they think is important for everyone to know, and we'll finish up?
Tom, you want to go first, or you want me to?
Sure. Thank you, Johnny. Professional respect and courtesy to all. This is a great industry. It's a phenomenal opportunity for all of us to make a better than average wage, serve our communities, represent our communities. I'm just glad to be a part of it. The Real Estate Podcast is a great forum. My peers, Tracy, John, I'm honored to be a part of what you guys are talking about today, and I look forward to the next opportunities. So thank you both.
Thank you.
And this time in this year, I just remind everybody to get uncomfortable. If it feels hard, great, you're doing it right. If it doesn't feel hard, you're not giving it everything. Get off your ass, make a few more sales calls, call a few more people, care more about your client than yourself, and give more than you think you deserve.
Yeah.
And that will make you survive this year.
Super.
Agreed.
Thanks, guys. Appreciate it. I think this is a good episode. Anyone listening, whether they were a real estate agent or a loan officer, would have got something out of it there. And look for more hot topics next week.